everyone for joining us. First, I'd like to attract your attention that you can access the audio portion either by VoIP applications or teleconference. So, to enable teleconference, please go Communicate under Main menu, then Voice Conference, and select Join Teleconference or Conference. Please, you all can hear us. And so you send a plus or Y in order to see that everybody can hear. Thank you. Thank you. So we have chat where you can ask questions, and we have a special questionnaire Q&A where you can ask questions during the webinar, during the presentation, and then I'll ask the presenter all these questions for a moment. So let's start. Today we're going to discuss a very important question in modern trading. This is auto trading logic and methodology. I introduce the presenter of today's webinar, Krishtop, who is founder of edgesense.net, which is focused on consulting in automated trading, and is known for his uncommon views on markets and trading, which help to gain consistent profits. Alex, it's all yours. I'm glad to see you here on our webinar.
Thank you. So the title of today's webinar is How to Build a Robust Trading System, a Beginner's Guide. Of course, this sounds loud and proud, but I should note that it is not a complete guide. It is not an academic research. It's not an academic book on how to build a trading system. It's only a beginner's guide. That means that I will outline the whole process, but in fewer details, leaving a lot of interesting, really exciting things in the research and development domain up to you. I'm going to speak about the approach to trading systems that I personally use to construct automated trading system used for trading forex and futures. One of the approach known like as quant, and means that some high mathematics is applied to price time series, and therefore it says about the probability of the future of this time series, or generates buy and sell signals according to some mathematical model. The fundamental approaches that trade news or some macroeconomical factors or anything like that. My approach is first find real repeating market inefficiencies caused by natural market phenomena, and then translate these inefficiencies to any language, to algorithms, then trade them with any necessity to modify parameters, to do optimization, to optimize systems over time. And another bit is that we always know why this system works. It may not work, and we can know when the system is about to stop working. Let's start with all the steps of building a trading system based on common sense. This is just a CFTC risk warning. It's required warning that says that futures and options trading involves substantial risk of loss. It is not suitable for investors. Well, I in this presentation. So, the research and development process in 5 steps. A certain trading idea, the implementation of a trading idea into code or algorithm, testing phase, then or relation of testing with assumptions, and the evaluation of the robustness trading system. First is trading idea. It's important to understand, even if we talk about technical analysis, even if we talk about automated trading systems based on algorithms, the idea is not technical indicators or any indicators at all. Because any indicator is simply a derivative of price, time, and volume. Okay, you can use also open interest for options. It can use other information, but in the long run, an indicator tell us anything more additional information that originally is within price time series. So, typical mistake of a beginning developer or a beginning trader is an attempt to explain market behavior technicals. For example, because crossover or because of an RSI crossing from below 60 or crossing from above 70 or anything like this. But if we try to understand the real process behind the movement, we cannot use such an explanation because this is not an explanation. This is simply a simplified view of the time series. For this example, we can answer because slow or fast moving average crosses above slow moving average, because a moving average is crossover is not an explanation of anything. It's just a sign that digital filters, low pass digital filters, produce two forms and slightly faster than another. So this is all we can say looking only at technical indicators. So this is basically what I've just explained. We use technical indicators as explanations or definitions of market inefficiencies or market processes. So a slightly better representation is, for example, saying that close prices tend to rise on average, or short-term average market bias is greater than long-term. Better explanation. But what is a trading idea? Idea is an attempt to exploit a known, recently repeating market process. Would also add a reasonable market process. Basic examples of market processes are below. Accumulation, where big companies, big funds accumulate their positions. Profit taking. This leads to a so-called sideways market. Covering losing positions, especially when winners are quickly into losers. This process leads to very short and at the same time sharp down moves, and this is exactly why positions are called short, because they're short term. Although there are less evident market processes, for example, market making or arbitrage or hedging, but retail trader, and I still assume that most of our audience are retail traders, is a little bit difficult to study these processes, and even if we have enough information about that, it's difficult to exploit them because that they produce are of on the one hand of very short term, and on the other hand they're very small in the absolute value of the move. So this is, I would say, dangerous to try to exploit these processes. Retail trading. Instruments that are available for retail trading could be divided into two classes. I would call them directional, that accept directional trading like shares, spot currencies or stocks, and positional as options. I won't cover options trading because I'm not that proficient in vein, so we will focus mostly on directional trading. Today we'll see the directional trading on currency futures and a single process of assets accumulation. Of course, more trading ideas, and I tried to give hints about what these trading ideas could be and where to start searching for them. Today we will consider the single market process of assets accumulation. So we need to understand which market participants may affect price significantly enough that it would be possible to profit on price changes. Can be retail, of course, because retail trade too small sizes and they cannot affect market significantly. Well, of course, if you, for example, buy 20 trucks of ES during night time, you may the price 1 week or maybe even 2 ticks, but this is not the size of a payment that could be significant enough to gain some profit on that. So of course, that actually drive prices during assets accumulations are institutions. About institutions that are likely to buy regardless of the price in huge volumes. Of course, these are they are unlikely to be hedge funds. Mostly they are pension funds, mutual funds, so family offices, something like that. So we need their psychology. What sort of assets are they likely to buy? Better requirements very forward. The assets should be highly liquid. They should be absolutely sure that they can trade of their position at any time they like. It demonstrates steady trends, preferably kind of an asset, provide opportunities for hedging. Which ones meet these requirements? Well, gold has been a favorite among many funds before just most recent days. Metal, excluding perhaps copper. Of course, currencies, the euro, Swiss franc, and the British pound. Or gas. I would even say that gas, even to lesser extent than oil. And it is, well, today there are a lot of talks about the commodities bubble that is going to burst. And that commodities, in fact, especially commodity futures, are and not proper instruments for hedging or to invest. But anyway, we need to understand that during many years, at least since 2005, commodities and commodities futures completely met these requirements that we just talked about. As you can see, we're painting this picture of a typical guy sitting at the desk at some large institution making trades, and we're painting this psychological portrait of such an institution. So the very question is, how are they likely to trade? Of course, their horizon, time horizon, is not days and not weeks. Normally, it's months and sometimes years. So this is the only explanation why they do not care a lot about the actual price at which they enter, because it is so far both in time and price that they unwind this position till have a profit. At least we can say for sure that they hold this position for at least more than 1 day. Accumulate these assets in some prolonged time. The question is exactly when are they likely to enter? Well, just to take my words for granted, because I talked a lot to guys at trading desks, and to my surprise, I found that they do not look higher mathematics at the simple things. For example, sometimes they do not analyze markets using technical indicators at all. So if there is an upwards movement that seems to be consistent to them, they buy. On the other, they all work according to their working schedule. Trade during night time. They trade only according to their working schedule, with the lunch break. So now try to implement our theory that we roughly drafted. We're going to use euro, as the euro is perfectly matching all the profile that we initially discussed. It is liquid, on straight trends, asset can be traded both in spot and the future. Therefore, it provides opportunities for hedging. To step 2, I would like to ask if anyone has any questions about what we discussed so far.
So we have one question, but I'm not sure if it's related to what you have discussed, explained. So you probably see it. Could you please give an example of market inefficiency?
Well, okay. That I've explained that. And efficiency is, well, the theory of market efficiency says that at any time, provides the best opportunity to fill the order. Some market philosophical category is able to do that. This is market inefficiency, and these are perfect moments to make trades, to initiate them, to unwind them, or sometimes even to trade only during this inefficiency. Typical examples of an inefficiency are these: when liquidity is low, and after moments liquidity explodes. So an inefficiency that leads to some price move. These are like when there are too many buyers or too many sellers, something like that. So we understand under conditions this may happen. And if these conditions are repeating, we may exploit this on a regular basis. So this is what lies in the foundation of such an approach to developing trading systems.
Also, one more question from Albert Smith. Trying to understand how, just a moment, how it works. Is behavior patterns are not the same as chart patterns? Could you go on this subject and maybe do a webinar? This fundamental subject.
Well,
just perspective.
Chart patterns. I was talking about chart patterns like double tops, double bottoms, head and shoulders, and so on. Well, it is really some connect to the market inefficiency, to the behavior, pattern of behavior of market participants, but unfortunately or not unfortunately, I don't know, most of the time they don't correspond to each other. However, if you just simply analyze, well, first of all, if you work with chart patterns, you will quickly understand that they are very hard to be formalized. It's difficult to have a formal, absolutely formal definition of a chart pattern, even for, say, double top or double bottom. We're trying to work with patterns of behavior that, on the one hand, have explanation why it may happen like this, and on the other hand, they're far easier to be formalized. So this is what we're going to discuss, well, on the second step of the development.
Thank you, Alex, for the answers.
We'll probe our idea on the euro. I've explained why we choose euro. Now we should make the trading rules formal, because form that they were formulated initially, it's impossible to write in any programming language. So first of all, we need to formalize what a persistent upwards movement means. For this purpose, there are a number of classical indicators. Let's use some momentum indicator here, for example. My favorite among momentum indicators is RSI, but let me repeat that what I'm saying right now is not something carved in stone, and I highly encourage everyone to try to build his own system using other implementations, other indicators or functions. Use these guidelines. So in this example, we will use RSI, and we suppose, again, it's just a supposition, that if RSI is over 50, we have a persistent enough upwards movement. According to their working schedule, we add some time restrictions on entries. We said, for example, they cannot be taken during night time, confined only to working hours. We remember that suppose that these institutions hold position for at least one day, so we will hold position overnight. The good is always how do we exit. Many exit strategies, in fact, they can be separately or in combination with each other, and most of the time I use 2 or 3 different exit strategies. Some of them are just stop exit strategies, and mostly stops are used to protect position against something absolutely unexpected, unfavorable to this position. Others use time-based entries, like we're going to use in our sample. For exit strategies, they are a bit more complex, and but essentially major kinds of these exit strategies. In our example, we will use only one exit strategy. We will exit at a certain time. The use language code that we're going to test. The first run of this test. From first run, we can clearly see that yes, there is some definite bias, upwards bias. At the same time, the draws are too deep, and those can be seen if we draw, let's say, parallel lines and compare the equity curve and measure the width. Of course, form is not something really, but anyway, we can see that we definitely have something with our strategy. And let me remind us, we actually implemented. We at 7:00 a.m. overnight at 1:00 after midnight. We have options that RSI value crosses above 50 and the time is greater than E time. That means that it's now working hours. So in hours. RSI crosses above 50 and we exit next day at 1 o'clock, we have this for such a primitive strategy. First key metrics of the strategy. This is also very important. How to measure, evaluate the fastness or performance of the strategy. We have about 1,500 trades. The trade value is $43, 53% winners, and loss ratio of around 1. So you can say that we have, due to this low loss ratio, we have these drawdowns. But at the same time, it's very important to compare these two figures with both win-loss ratio of over 1, that is, the average winner is greater than the average loser, and find at the same time over 50% of winners. So, in fact, this is good. This says that the strategy does have some potential and should be refined. Essentially, we need to exclude some losing trades. We need to find the conditions under which we do not enter, and therefore we have a chance to improve the metrics of this strategy. So this is exactly what the improvement phase is all about. Actually, we made 3 main assumptions. That movement is persistent if RSI is greater than 50, only after certain time, and only at certain time. Well, the obvious assumptions, and we're going to make some research on the assumptions. So, the improvement phase is actually the most interesting part. This is the research. First, we want to see how the threshold for the RSI indicator affects the overall performance. If down the threshold, winning absolutely unpleasant. Well, we still have too many trades, and too many trades lead to losses. So instead of anything slightly reminding linear growth equity curve, we have something oscillating around 0. So, okay, this is as we expected. We already saw. Now increase the threshold. We increase the threshold, and therefore we exclude, because, well, this is obvious that the higher the threshold, the lower the number of trades. If the threshold to this extreme value of 80, we well, say the good performance till sometime in 2011, then suddenly is sideways. The threshold, the less the number of trades, the more down for strategy. Because the key metrics are trade value, percent winners, and win-loss ratio. But at the same time, we experience issues with performance, and this is more evident. Okay, we made some research on the RSI threshold. We tried to filter out rigged trades, let's call them this way. Now, let's make a quick research on timing. Initially, we assume that trades should be initiated only after a certain time. We what we limit not only the beginning, but also the limit for the ending time during the day. We know that institutions have 9 hours of work. Okay, we try trade only from 6 a.m. till 6 p.m. Let me remind you of how it looked initially. So we got rid of this very unpleasant situation. We've seen here. Have it anymore. Yeah, we do have this large down, then in run up. Look at which year it happened. It becomes obvious why it happened during that time. The visual representation of this equity curve becomes slightly better, but let's look at the key metrics, because first is the answer. Initially, we had an average trade value of $43. Now we have 62. So we proved this metric. Initially, 1,417 trades. Now we have 1,230 trades. I also mark it in bold because that's the number of trades. In fact, better. Well, of course, if the average trade value increases. So this is a sign that we do not over trade. Have the same percentage 53. Okay, this is good, and we slightly improve the win-loss ratio. Now, I can make a quick break for questions if anyone has any.
Right now, the first one was how do you use time-based charts? The considers maybe Renko bars or some other orange bars other than time-based.
Well, for lovers of Renko bars and other exotics, I would strongly recommend to review my previous webinar with MultiCharts last year. This recording is both on the site of Edgesense Solutions and on the MultiCharts WebEx site, where I covered all these exotic charts and explained why it is very, very dangerous to use them, because it is very easy to have astonishingly perfect results with them, and then as soon as you try to live trading, it immediately starts to lose. So I covered all these things in most detail and explained why. In my opinion, well, as you can see, I don't tie myself to time-based charts or range-based or volume-based. Mostly, I tie to charts at all because I have an idea. And I'm trying just to find an implementation of this idea. If we know that during some time, let's say certain days a week, like if price moved several amounts to the side or to the downside, then it's able to buy or sell. And generally, it's not that crucial which kind of a chart to use, because the RFI is the author that we're using in this research. This is based on time bars. Okay, you can imagine any other momentum indicator indicator. For example, your momentum just compares price now and price some time ago. In this case, it's absolutely different which type of a chart to use.
There is a following question, actually the same topic. Will there be example based on price charts?
What?
Price charts. Price-based example.
Price and you mean that, for example, if this price is greater than some other price,
well, I assume yes. We can ask the author of this question to specify it.
Yes, please.
Yeah.
Because it's not completely clear to me.
Yeah, I do agree. So please specify the question, and we'll be glad to answer this. And one more. Use optimization feature of MultiCharts during the improvement phase.
I do not, well, I do use optimization, but I use it for very special purposes. I do not, the application is run, and then a single parameter is taken that corresponds, for example, to the best net profit or the best profit factor or something like that. Instead, the optimization engine in MultiCharts is a perfect tool to generate tables of distributions of certain metrics or certain parameters, and we can then build, for example, like heat maps, and we can find what I call islands of stability. Because if you, for example, divide the trading session in hours and you divide at the same use it on x-axis, and you divide the RSI in steps of, for example, 5 and plot it along the y-axis, and then you plot the heat map for the profit, you will see, in fact, you will see very interesting pictures. They will be repeating, symmetric, and so on, so on. But I will not cover it during this webinar. I'm leaving it to you because my goal now is only to give some guidelines of how to use it. Everything else, of course, it's your own research.
Okay, and yeah, speaking about the previous question, the audience just prices, so that's just price-based example.
No, I suppose I don't have a price-based example because the chart is the only representation that with which is possible to work in MultiCharts.
Okay.
Test anything using, well, as is. So the energy of MultiCharts is that the basement element is chart, and everything else, including functions, indicators, and strategies, are tied to each window. So of course we always use charts.
That's correct. Okay. So these are all questions at the moment. So dear attendees, please ask more questions, and during the next pause we can ask them to Alex.
Okay, now the evaluation phase. Well, this phase is also a intermediate step, because if we evaluate our strategy and we find that it is not usable in real life, then we must repeat our investigation process. We should go back to implementation, to correct implementation and testing. For evaluation, we use slightly more metrics that tell us some other information about strategy performance. The integral metrics that we normally use are value, the possibility to trade this strategy in real life, because, for example, if you have an average trade value that is compared to the commission plus slippage, then of course this strategy cannot be traded live. We evaluate the percent winners. It tells us about if this market process that we supposed is persistent or not. So normally we need to have all 50% winners. And win-loss ratio is that we do not outstay the drawdown in normally vain hope that price returns to our favor. Far interesting are discrete metrics, and among those, maximum adverse excursion and maximum favorable excursion are perhaps the most interesting and most useful. So, what is adverse excursion? As you read on this chart, denotes a losing trade. On the axis is the down has been experienced inside the trade. On the y-axis is the final loss. So for this trade, I'm sorry, too thick. For trade, we had the maximum drawdown inside during this trade. Size or the maximum loss. So it simply means that at 1 o'clock next day, we exited at the worst price possible. Cases, for example, a drawdown of $4,000, but then price back. The final loss was only 2,000. With green dots, it's the same. That, for example, we experienced a drawdown of 1,000, but the final it was 6,000 for one trade. More likely, it is above 1,000 and a half. What makes game reasonable is that you can see that these drawdowns trades normally are much smaller than those for the losing trades. This is one of the easiest and at the same time efficient methods to apply hard stops. For example, you can cut the losses level of 2,000. We limit ours, so allow trades like and deserve all our winning trades. Terrible excursion is the opposite picture. How far the traveled during in our favor during trades, red dots, and winning trades, green dots. You can see that if we had a loser, then it is unlikely that the favorable excursion was let's say 1,000. Another hint. For example, we can add a more sophisticated exit strategy. For example, if we already know that we had a favorable excursion of less than 1,000 and we already the down over then we exit. We do not till this position turns into a deeper loss. This picture normally is used to set profit target orders, but as you can see, as all limit orders, and profit target is a limit order, it reduces your profits. So no reason to use profit targets, and I do not use them at all as exit strategies. See now equation, wouldn't stop at put at 1000 be better? It wouldn't, because if you place the stop here at 1000, quite a lot of profitable trades losers or 1000. Not a good idea. Again, a hard stop should be something that prevents us from a really disastrous way of things. And therefore, it should be placed, in fact, as wide as possible. Simply not to interfere with the trade, not to interfere with the potentially profitable trades. So these are another metric or metrics that are trade series statistics. This is very, very interesting and at the same time very important. Well, what it says that after the trade of having another winning trade 3 times less a losing trade, unfortunately, with that system. With is a trading series of one winning trade. This means that after this one winning trade, the next trade was a losing one. Means that this was a trading series of 2 winning trades. This is that after 2 winning trades, the next one was losing trade. Okay. The alternative thing about our strategy in this back form, this way, is that we have what in statistics is called fat tails in win trade series distribution. So for the single trade, unfortunately, we have more single losing trades than more single, but if you look at series of 2, 3, 4, and 5 winning, you will see that their number is greater than corresponding numbers of losing trades. So again, says that we have caught some cases of the real market phenomenon, market process, and it is all still to perhaps improve the strategy, removing, for example, single losers, therefore improving the overall metrics. Another statistical metric is outliers. So what is the outlier? The outlier is the trade which value is too far from average. What is too far? Of course, this is just standard deviation of average trade. In our case, in our initial case, of too wide deviation, it is simply too large. And the number of outliers is magnitude less than the number of trades. What makes our initial strategy, unfortunately, not that good is that the outlier profit loss, total profit loss, is negative, unfortunately. So we do not still have a statistical advantage in our strategy that leads us to profits. Unfortunately, the trades leads us to losses. So let's give some information about the smoothness of the equity curve. So instead of just discussing the visual representation, we have some metrics on how to measure the smoothness of the equity curve. There are also many more metrics that relate to robustness of the trading strategy. That is stability through parameters deviation, for example. It is, for example, if we have a strategy that works excellently, if a parameter is, for example, 55, if a parameter is 54, it loses, then of course there is no stability to parameter. So a parameter slightly must lead to slight change in overall performance. This is not the fact, then something really very wrong with this strategy. A very powerful thing is regression analysis, and for those interested, I would also recommend to review the first webinar that I made with MultiCharts. It can be found either on the site of Edgesense Solutions or on MultiCharts WebEx site. This is the very first of the series, where I discussed the regression analysis applied to the evaluation of the robustness of trading systems. And it could be behavioral analysis, seasonality analysis, and even intermarket analysis, but these things are unfortunately beyond the scope of our today's webinar, because I'm looking at the watch and I can see that unfortunately our time is almost over. Also, we initially built a strategy based on common sense, and is supposed to exploit a certain model of behavior of large market participants. It fails when the model changes. So, for last year, it was uncertainty with the euro. Therefore, the strategy ceased to work. The consistent growth this year, and in 2013, as the Eurozone tends to come to an end. We'll see, of course we will see, and again let me repeat that I do suggest to use strategy as is one from tomorrow, was not. This is again just an example of find an idea how to convert it into code, how to test it, and how to evaluate it finally. And also, what is most important is that with this we stand conditions that may to work. So this was the outline of a typical research and development process. Just to give you the basic idea of how a work of this kind looks like. And let me repeat once again that any idea requires far deeper analysis than presented above. Just give you simple figures that 90% of new strategies that are designed do work absolutely. 1% of the strategies are consistent, and 1% of the strategies are really robust. So you have plenty of information, you have plenty of resources, you have plenty of opportunities to build your robust trading strategies. Just to give you an example of how a good strategy may look like. This is a reference portfolio, just a portfolio of three futures. Yes, it is the future and the gold. I compare these figures to what we had during our research. The average trade is power of magnitude greater than we had. It is more than $300, and of course it covers all the expenses of commissions, slippage, whatever. We have 60% of winners, and at the same time, 40% more, 40% greater average winner than the average loser. Factor is close to 2. Standard deviation, I hope that you remembered this metric, is just $100. Now we will quickly go back to that analysis. We remember this. We had an trade of just $63, deviation of 900. It is power of magnitude greater than trade. Good trading strategy. These are of the same power of magnitude, just 2 greater than the average trade. But not the least, the profit loss, the total profit loss for outliers is positive. This means that even for abnormal trades, with our trades, so that this led us to winners, not to losers. Just as a very brief remark, this reference portfolio, in fact, is a product that now is offered quantity of Optimal Futures Group, and if anyone is interested in trading this portfolio, please call Matt Zimberg, the CEO of Optimus Trading. Call him on Skype or email to matt@optimusfutures.com. Now I'm ready to answer any questions that you may have, and for those interested in improving the skills in research and development and learning more and learning to get a much more deeper understanding of the total process of evaluation, of research, and planning trading strategies, we have a special individual course only for select persons with some basic level, and you can find information about this course at our website. But first, please feel free to email your questions to info@edgesense.net. So thank you very much for your attention. Now Please proceed to your questions.
Thank you, Alex. So we have just questions here. How do you take into account any money management max loss for portfolio if you don't have stop loss?
Well, this is not correct. I never said I didn't use stop losses. Well, I do. And I explained the principle the placing of stop losses. Besides this hard stop or agency stop that I call it, I have several dynamic stop strategies. To clarify, this is nothing in common with, for example, parabolic SAR or anything like that, but these stops are moved dynamically during the trade.
Okay, yeah. And there is another question, and I think you have partially answered this. What was the basis for saying the standard deviation was too high?
Well, I think I've explained it already.
Yeah, and then during your explanation, the author sent one that seemed to answer the question. Some standard deviation should be of the same power of magnitude as average.
Well, of course it should not. It should not. But this is simply better when we have so small a deviation of trades. They are all we'll have to let's go back to these figures. Have a standard deviation of the same power of magnitude as average trade, then we have more or less smooth equity curve. We have standard deviation, well, let's say power of magnitude greater than the average trade. We have this nightmare that we received during our trials. Simple. This is not the only metric. And again, we repeat that for those interested in serious evaluation of robustness of trading strategies and in equity curve analysis, please watch the free webinar that I made with MultiCharts, the first webinar in my series. I explained that in most details.
So, and all the recordings are available right now, and you can play back or download the recording and see more information and more material on this topic. Simply, the time is over, and I'd like to thank everybody for attendance. The talk and the material itself were highly attractive and valuable. Alex, thank you so much for your time and all the explanations that you've given to us.
Well, thank you, Catherine, and thank you, everybody. And I'm really sorry that I physically cannot answer all the questions because I can see a lot of them. But okay, please forward them to MultiCharts, to Catherine, or write directly to Edgesense. Try to answer all of them.
Yeah. So I hope that the knowledge our participants earned today will have them to improve their auto trading significantly. And your questions to info@edgesense.net or to MultiCharts, to support MultiCharts.com, so we could forward all the questions to Alex. And the webinar has been recorded, and it will be uploaded on the site within 24 hours, so you can go back and listen it one more time. Again,
thank you, everybody. Okay.
Great weekend.
Good weekend, everyone. Bye.